All right, everyone. Testing, testing, 1, 2, 3. How are you guys doing today? All right, everyone. Testing, 1, 2, 3. Good deal, good deal. We appreciate you guys taking the time to join us today. We have a great crowd in the room, and I know that you guys are definitely in for a good treat. We are recording today's event, and so again, we'll get that out to you. Basically, what we do, we'll get it uploaded, emailed, and sent over to you by email with a copy of the recording. So take as many notes as you can, ask questions that you have for John. He's going to be here live today, but know that we will get you a copy to review on your own time. I think it was about two or 3 months ago, John spoke to our group and did a great job, and I would like to just take a second. A friend of mine is in the room, Jeremy Tang of sharkindicators.com, and they are one of the sponsors of Trading Pub. So for those of you that have been to our site, you know that all the education's free. We've got a lot of great content on the site. We do these classes, and we're able to do that in part because of sponsors like Jeremy and Shark Indicators. And we appreciate him being here and John being here as well, taking time out of their day to provide some good quality education. So real quick, before we get started, if you can, type in where you're joining us from. If you can, type it in. It's kind of fun to see where everybody's tuning in from. Looks like we've got New York, Colorado. Here's a quick look at the map that you can see. We've got the globe pretty well covered. I think we've got just about every continent covered. Orlando, Chicago, Poland, Vancouver, Alabama. Hey, Claudia, where in Alabama are you? I'm in Mobile. There's Chicago again, Ron Fielder, Atlanta, Cape Town. Looks like we've got a couple South Africas. Hungary, Italy, Dallas, Texas. Good deal. Well, we've got a great crowd. We really appreciate you being here with us. I know you're in for some good education, and I'm going to go ahead and turn it over to John. John's going to give you guys some good ideas on trading with Fibonacci. And so, John, you can go ahead and take it away. Thanks again to him. Be sure to check him out. I'll type in his website next, www.nexgent3.com, and then www.sharkindicators.com. Check out our friends at Shark Indicators as well. All right, Jeremy, you can take it away. Or sorry, John, you can take it.
All right, thank you, and welcome to everybody. I really appreciate everybody taking the time, especially those of you guys that's 3 or 4 o'clock in the morning. I know it's staying up late sometimes to watch these things, so we're definitely going to make it worthwhile. I've got a lot of information that I want to cover in this webinar. Obviously, we've got to put up the disclaimer. Take a second to read it. All right, did everybody get it? We're going to move on. One of the things I want to talk about, successful trading. And that's really the goal and the objective for every trader making money. I've tried to define successful trading in as small a space as I possibly could. Really the things that you need to know in order to be a successful trader, you know, as far as methodology goes. Where to get in with the least amount of risk and where to get out with the maximum amount of profit, or obviously we're going to have losers from time to time, the least amount of loss possible. And it's my contention that if you have the ability to really repeat these 2 steps day in and day out consistently, you're going to have the opportunity to be successful trading in the market. Talking about conventional wisdom, one of the things that you've heard and has been touted forever is buy low, sell high. And the problem with this wisdom is that there's not really a clear-cut definition of what's low and what's high. You know, there's a lot of different indicators out there and there's a lot of different methodologies out there. And what I'm going to really attempt to do and show you guys with our Fibonacci confluence areas is that we're going to be able to actually predict the lows and predict the highs, and we're going to put together really a trading methodology that you'll be able to implement using Fibonacci support and resistance areas in a very, very short time frame. So Um, Before we jump in and show you how much money you can possibly make with this methodology, we have to go through some basics. We've sold software to the public and really worked in this business since 1997. And, you know, if you add up all the years in front of the computer and the things that we've done, we've narrowed down and really have been consistent over the last 10 years with an array of supplemental indicators that we use that, you know, resemble moving averages. We're going to go through all of them so you can kind of get a feel for them. But everything that we do is based around Fibonacci support and resistance. And what we do is we use these additional indicators to help us determine when Fibonacci areas of support and resistance are going to hold, and also to be able to anticipate when these areas are going to break. So what I want to do real quick is go through the looks of each of the individual indicators, because it's going to help us build a foundation for the trade setups and the trade rules that we're going to go through a little bit later during this webinar. So we're going to keep it very simple to start off with. And we have two what look like moving averages, and they're actually linear regression and linear regression averages that we use. And it's not a secret. I mean, they're pretty easy to duplicate. It's a 20 period and an 80 period. So instead of using a normal 200 period or 55 period moving average, we're using a 20 period linear regression, and we're also using the 80 period so we can have a longer term and a shorter term. Now when we look at these two things overlaid, and you can see the smaller white lines are what we call our small triggers, and then the colored ones that are green and red are what we call our large triggers. Now they give us a lot of information, and without going too deep into mechanics of linear theory and everything else, the very, very short version is that we're trying to draw a straight line with data that's not straight. And what happens is it allows us to put together some very consistent analysis of price data based on the look and the position of what these trigger lines are doing. So a couple of things that we're going to use them for. Number one, and you see these price bars right here that aren't touching this small white average, our small triggers. Okay, when price is pulling away from these small triggers, it tells us what? That we have momentum in the move. And as the market and the linear regression lines and the averages catch up, you'll see that price bars are actually inside of the trigger lines. And what that tells us, or gives us a heads up, if you will, is that we're about to have or having a loss of momentum. So first we see momentum, second we see a loss of momentum, and then we end up with a reversal. We also, very standard, it's not anything really tricky, when the fast moving average is above the longer term one, typically the trend is up, and when the small moving average breaks through the larger one, we see that the trend changes to down. So pretty straightforward, but this is going to be one of the building blocks that we're going to use as we move forward. One of the other things that we look at, and you'll see it happen, and it's just something to notice, is that, and a lot of people use divergences, but the linear trigger lines, we're just going to call them trigger lines from now on. When the trigger lines fail to follow price action, meaning price action is making new lows, but the trigger lines don't make new lows, or price action is making new highs and the trigger lines are not making new highs, that gives us an indication that there's a potential for a reversal in the marketplace. Okay, pretty straightforward stuff. You know, if you guys have questions, please, if you would, save them to the end. I'll be more than happy to answer any questions that you guys have. One of the next things that we look at in our trigger lines is a failure of these trigger lines to follow along with price data. So what we end up with is initially our fast and slow moving averages are crossing over each other. So we start to anticipate, hey, there could be a potential trend change to the upside. And what we recognize in the look that we're going to be looking for in our indicators is when these large trigger lines don't follow the price action up. And what that does, and remember what we talked about, these equations are trying to draw a straight line with data that's not straight. So what you find is that if the price goes one way and the triggers are still going the other way, you tend to have a snapback type effect, as if you were pulling a rubber band and snapping it on your hand. So the further price pulls away from trigger lines that don't come along, we'll start to anticipate a reversal in market price direction. Another common occurrence that happens at least 20 times a day is, and something that we use on a very consistent basis, is the first touching of the trigger lines when they roll over. So in this scenario, or this picture here, you'll see that the market was going up very, very strong to the upside. And it started to make a little retracement. The trigger lines rolled over. The market pulled back to the trigger lines and immediately bounced the market back down to the downside. So it's this area, or this first touching of the trigger lines when they roll over, that we're going to use for our advantage. All right, now you're going to see this same concept be true in the larger averages as well. So you can see here our large green trigger lines have crossed and rolled up, and they're spreading to the upside. The market pulls back into them and touches them and immediately bounces off of them up to the upside. Same thing happens to the downside. The small triggers break through the large, changing the trend to down. Price will pull back, touch these trigger lines, and then bounce to the downside. The chart type that I'm using is a Renko spectrum type chart, and we'll get into that a little bit later. I'm not going to really get too much into the description, but it's a very smooth price action bar. I've got a video on our website that explains it perfectly versus ticks and minute charts, but didn't really get into what the bar type is in what we're doing here, just so you know that. One of the next things that we're going to be looking for is whether these trigger lines are loose, what we call loose, meaning far apart, or whether they tighten up and come together. And what we've found is that when these trigger lines come together, either breaking through at the top or pulling back and the small trigger lines touching the large trigger lines, it creates an opportunity for us as traders to really focus in on a very narrow spot. So this is what we call a tightly stacked area. And these are areas that we're going to use later as we talk about trade setups and rules for actual entries around our Fibonacci areas. One of the other things that you'll see in this trigger line scenario that we have set up is what we call a stab back. We call it a lot in our educational room. And long story short, you'll see our small trigger lines are coming down, and they're wide and angled to the downside, and the market's moving to the downside. Now, this trigger line continues in a downward direction. So it's leading lower, and what happens is the market tries to pull back, and that's what's creating all of these little tails on the bar. The market's trying to go the other way. The trigger lines are going down. The market's trying to go up. Again, creating this tension between price action and the trigger lines. And these are going to be opportunities for us in the future. And you can also see right here a very good example of that. I didn't mark it on here, but you can see that the trigger lines are going up very strong, and the market pulls back and touches this large trigger right here. So you can see how we're going to start to layer in some of these cause and effects. So we talked about the first touch of the large trigger lines when they roll over. Then we talked about small trigger lines continuing in an upward direction and having these little stab backs or pullbacks against the trigger line direction. Again, it's going to be a very key point in some of the stuff that we're going to be looking at. So just to kind of look at a little bit of cause and effect on just a couple swings in the market. Notice that price makes new highs right here, and the trigger lines don't, and the market sells off. Then the market takes off to the upside again, and while we pull back into our large triggers that are rolling over, the small trigger lines at the same time don't come along for the ride. So remember, we talked about if the trigger lines don't come down when price goes down, then we're going to expect that snapback and that bounce, if you will, off of an area. And that's really what we're trying to build, is we're trying to build some criteria. So when we start looking at our Fibonacci areas, we can anticipate whether these areas are going to hold or break, and this is how we're going to do it. One of the other things that we use a lot, and I'm sure most of you guys use it as well, is MACD divergence. And very simple, easy concept. Price makes new highs. The MACDs do not make new highs. We anticipate the potential for a reversal after the MACDs fail to make new highs along with price. Same thing holds true on the bottom. So we have a slide in here for divergence on the lows. And you can see very clearly the MACDs go up. They don't make it a new low. Price makes a new low, and then we look for a reversal. So again, just divergence on the highs and divergence on the lows are really key concepts that we look for. One of the other things, and you don't have to necessarily make a new high or a new low in order to see divergence. We use what we call retracement divergence. So for an example, in this example, price doesn't quite make a new low. Maybe it's 80%, 786 retracement. But if you look at the corresponding swings in the MACDs, maybe there's a 20% retracement in the MACDs. So even though we didn't make new lows, we're still able to take a look at this area and say, wow, the MACDs are really, really, really diverging against the depth of the retracement in price. And that's what we call retracement divergence, so you don't have to necessarily have new highs or lows. We also use the MACDs a lot for a loss of momentum. So if we were in a short trade, whenever you look at the MACDs, and I know a lot of people have this now, what you're looking at, the dots themselves are a MACD calculation, and there's a Bollinger Band wrapped around the MACDs. And Bollinger Band theory is pretty simple. When they're wide open, you've got a lot of strength and momentum, and when they pinch together, change is going to happen, and you're going to get a breakout one way or the other. So if price action is coming down and the Bollinger Bands and our MACDs squeeze together, typically that's an area that we're going to anticipate seeing a reversal in the market. So the other thing, just to kind of give one more slide here, if you go back and kind of squeeze up a chart and look at it, you'll see there's a lot of divergences in the MACDs between MACDs and price. And these Renko type charts create a much smoother chart and filter out a lot of the noise in the chart. So the pivots between MACD divergence and the highs and lows typically works out very, very well for what we're trying to do, which is buy the bottom, sell the top using Fibonacci areas. We use the MACDs in one final way when we're looking at trend trades. What we want to see, and we'll just kind of discuss two looks here. Obviously, a momentum look in the MACDs means that the MACDs are above the top Bollinger Band or below the bottom Bollinger Band, and that just tells us that we have a lot of strength and momentum in that move, and that's really what we're going to use when we're looking at one of our three types of trades. We do trend trades, we do momentum trades, and we do counter trend trades. So when we're doing a momentum trade, we want to see this momentum look in the MACDs. Now, when we're doing trend trades, first you want to see a momentum look in the MACDs, and then you want to see weak retracements throughout the trend to the downside. And we define a weak retracement or a weak pullback as any retracement in the MACD that doesn't exceed the opposite Bollinger Band. And typically what you'll see when you get a strong move down and then a retracement in price and a weak retracement in the MACD, that the trend is going to continue. So it's a very helpful tool for us when determining do we want to continue trading with the trend, or do we want to start thinking about going the opposite way? All right, so we talk a lot about Fibonacci, but we haven't done any Fibonacci work yet. So I wanted to, and I'm not going to bore you guys with an hour dissertation on how to do Fibonacci's, but I thought I'd give you at least a 5-minute version of what we do in our software and how we put together these Fibonacci support and resistance areas so you can understand why they do what they do and how they are put together. I'm of the belief that the more you understand about the methodology that you're trading, the better off and more comfortable you're going to be. So when we look at Fibonacci ratios, and this is the tool inside a NinjaTrader, there's a lot of different Fibonacci ratios: 100%, 138, 1618, 2.618, and then you get into retracements: 786, 50%, 38%. So these are all different ratios that we can use. And there's a lot of people out there that do Fibonacci. There's nobody that does Fibonacci as complete as what I'm going to show you. It's just impossible to do by hand what we're doing with the computer. Obviously, this is an older chart, but the method is still the same. Anytime you're going to do Fibonacci analysis on a chart, you must define the swings that you're going to do the ratios from. And as you can see, I just took a little snapshot, and obviously this is from a while ago, but swings are swings. And what we do is we define your 1, 2, 3 pattern. So you have a low, a high, a retracement. A low, a high, a retracement, a low, a high, and a retracement. And what you end up with is a bunch of swings. And then you can go to a higher time frame, and whatever is the one low here could be a 2, a 2 at the top and a 3 down here at the bottom. So you have different time frames that you can analyze, but what we're going to do for this is just kind of look at a single time frame here for the moment. So what our software is going to do once it determines the pivots is it's going to do what we call extensions. And it's going to take the distance from a number 1 to a number 2 pivot. So whether it's 10 ticks or 10 points, it just depends on the size of your chart. And it's going to take that distance, and it's going to multiply that distance by all of those Fibonacci ratios that I showed you. So it's going to multiply it by 161%, 200%, 261%, and it's going to project out into the future these Fibonacci numbers. And obviously the market hasn't gotten there yet, but it's just throwing those numbers out there. And what our software will do is it will actually do every swing 1, 2, 3 and run all of the Fibonacci analysis for you. Our software will then synthetically build 9 more higher time frames. So instead of all these little teeny tiny 1, 2, 3s, you'll get medium 1, 2, 3s, then you'll get large 1, 2, 3s, and then you'll get very large 1, 2, 3s. So our software is actually analyzing 10 time frames of Fibonacci analysis from all the different pivots. So once we do this work, then we do, and I really want to stress, we analyze every pivot, and we analyze the pivot from 3 different directions. Okay, there's an initial move, and then there's a retracement move. So what we want to do is we want to measure that initial move first, and that's what we're doing with these extensions. What we call expansions is we calculate the distance of the retracement. So what we're doing is we're actually taking the distance from the top or the number 2 pivot to the number 3 pivot and measuring that retracement. So at first we're getting the initial surge. We want to measure it and do Fibonacci ratios from it. Then we measure the retracement and we do Fibonacci ratios from all of the retracement values. Okay, and then we project those out into the future. And then we also will do your normal retracements, which most people are very familiar with, which is, you know, your 50%, 618, 382. So we're doing retracements, you know, sub 100% retracements, and then we're doing the first 2 initial over 100 projections, and then we calculate one more distance. We calculate and measure how far did that go from the number 1 to the number 2 pivot, and then we measure how far did it go down to the retracement pivot, and then from the retracement we project that into the future. So long story short, we're trying to hit this bad boy from all sides so we can really take into account all of the price data that's happened. So just on this single chart from a single time frame, I manually drew in all the Fibonacci ratios that you could or would end up with on the right edge of your chart. Keep in mind, you know, life happens on the right edge of the chart, guys. So this is the Fibonacci ratios right here. All of the retracements, all the extensions, all the expansions. So when you get somebody who says, oh yeah, I'm really great at Fibonacci and I do these couple ratios and I do well, that's fine. They, you know, they probably do. However, it's an art form. And, you know, there's a lot of people out there that do manual Fibonacci that do really well with it. I did manual Fibonacci for years before we wrote the program. You know, and this Fibonacci engine we wrote in '99. So it's been out in the marketplace as is for 14 years now. So I'm really confident that we've done it right. But when you look at the right edge of the chart, it's untradeable. Tell me where the market's going to turn. Anybody? I don't think you can do it, not by what we see here on the right edge of the chart. If you were to take 9 more time frames of Fibonacci and then take 30 days worth of data and then throw all that together, then you start to get an accurate picture of what our software is doing in order to generate support and resistance lines for you. And I wanted to go through that because when you look at what our software does, you know, let me change the slide here. That's what your chart's going to end up looking like. So what our software does is it takes all those thousands or tens of thousands of Fibonacci lines and it weights them. And, you know, weighting is important. Higher time frames get more power. Larger Fibonacci ratios mean more than smaller Fibonacci ratios. And our software will crunch all this down and generate the highest concentration of Fibonacci's inside of a small window and give you support and resistance. So, you know, I really did the song and dance to kind of explain it to you, because when you look at our charts initially, you're like, okay, there's red lines and blue lines. But when you really understand what goes into making those red and blue lines, that these lines are the result of hundreds of thousands of pivots and calculations, all crunched together and sorted and ranked for you, they obviously become much more powerful. So, you know, Fibonacci obviously over the last 10 years has really become mainstream. A lot of people say it, not a lot of people are really good at it. So, you know, Fibonacci works. Anybody who does Fibonacci and, you know, uses it religiously, you know it works. And everybody asks the question, why does it work? And, you know, in the end, who cares as long as it does? However, my theory is that because Fibonacci is found in almost everything in nature, you know, flowers to everything in nature, even to the human body, the markets are a function of you and me and the banks and the oil, you know, the oil firms and hedge funds and pension funds and, you know, everybody who makes up the market and buys and sells is human. And even if they're a program, The program was programmed by humans on what they wanted it to do. So because every move in the market is based on supply and demand, or somebody's fear and greed, or somebody's need to hedge a position, these are really the swings in the market, I think, are just emotional responses. And because we're able to measure and quantify every one of the swings and every one of these emotional responses, that we're able to predict the upcoming responses based on the summation of all of the prior emotional swings in the market. And that's really the premise on what I built the T3 Fibs Pro Trader on, is to be able to take what's happened, analyze it, and predict out into the future. And we've obviously condensed it down into very simple and easy to use red and blue lines, but these lines, we call them confluence areas. You can call them support and resistance. Really the magic comes in determining when you can use these areas to buy the bottom and sell the top, and to really put together a trading methodology around them. So let's talk about a couple things here. This is a chart, what our normal chart looks like. And you'll see there's red lines, there's blue lines. When the blue Fibonacci support areas break, they become red and they become resistance. And these areas get used over and over and over again. And what I want you to notice is, going back to what we talked about with our trigger lines. When we see our small trigger lines with strength and momentum and breaking through a Fibonacci support area, we do not anticipate that Fibonacci support area to hold. There is one support area that's going to hold, it's guaranteed indefinitely, and nobody can ever beat it. It's zero. I'll just tell you what it is. So if your stock goes to zero, I promise you it won't go any lower, right? But other than zero, every support and resistance is going to break, and every area is going to break. So what we have to do as traders is we have to have some facility to determine whether these areas are going to hold or break. So, a couple of the things that we talked about are going to be key. So let's take a look. Small triggers are breaking through Fibonacci support. It doesn't have any chance of holding. Notice what happens when we reach the next area of Fibonacci support. We have the small trigger lines fail to take out or to break through that Fibonacci support. So that's kind of a first indication that, hey, this thing may start to give us a little bit of trouble here. Then we end up with divergence in our MACDs. Does everybody see that? We've got lower action in price, higher action in the MACDs, and eventually our small trigger lines get above our large trigger lines, and then we end up with a Fibonacci support area in this area right here that we're going to anticipate has more potential to hold. And remember, we talked about the distance from the large triggers, that rubber band type of theory, if you will. Notice how the small trigger lines react at this red Fibonacci resistance area. Do you see this? Look at the small trigger lines at this blue Fibonacci support and how they're wide and angled and going through it. And then notice that the small trigger lines are rolling over underneath this red Fibonacci area right here. And then you add to that the distance back to our large triggers, which means we're probably going to get some type of a snapback effect. And then we end up with a red resistance area and a blue support area that we're going to be able to really incorporate some rules for buying and selling. Okay? Is everybody with me on this so far? Pretty simple concepts. I know if it's very new to you guys, might be a little bit confusing, but all we're looking at is where are these things and what are the conditions of the trigger lines at the areas, and can we start to layer together these indicators at these support and resistance areas. Now, you can have the exact same Fibonacci resistance area. So notice over here on the left, we've got a red line. That's our Fibonacci resistance. And it goes across, and then, we break above it, we break below it, we break back above it. And this is the same line, right? Whatever price that is, does everybody agree? Horizontally across the chart, that's the same price, right? Okay, so what's the difference? Why do our traders that trade our software sell right here and make a bunch of money, and they can't sell right here and make a bunch of money? So the difference between these two things is what we talked about with the looks. So let's start to layer together some of these looks that we talked about. We have the first touch of the large triggers that are rolling down, right? Anticipated to bounce to the downside. Red Fibonacci resistance area. Yeah, the small triggers did roll above it a little bit. But this ends up being a good area for us. Now, look at what happens when we get down to this Fibonacci support, which obviously would be your target area for any type of short trade that you are doing. Look at what our large triggers are doing. Is there any threat of the small triggers or the large trigger lines breaking through that Fibonacci area? There's no threat of it. So that means that we're probably going to see this Fibonacci support area hold. Now, when we get back up to, and trade through the cycle here, looking at this red Fibonacci resistance, look at what our large triggers have done. The large triggers have already led through and broken through, and then we end up with a trigger line divergence. Price tried to go down, and most of our traders would probably sell right in this area. But the ones that recognize very quickly that, hey, things aren't coming along, they're going to get out right here. So they might get in here, they might get out right there, and they're going to take a little loss, and that's okay. But when you recognize these things happening at the areas, you're able to really get the most out of it. So to kind of move on just a little bit here. We talked about the distance away from the trigger lines. So notice what happens when, and if anybody trade crude oil, you guys got this one today over and over and over. It was a range-bound market. And we were stuck in between a Fibonacci support and a Fibonacci resistance. This wasn't today's chart, but I do have it, but this is from months ago. But when you see these large triggers in the middle, and not threatening breaking through, you can start to anticipate choppy market, a range-bound market, and you'll start to see these Fibonacci areas hold. The farther you are away from these large triggers, the better the chance of these support and resistance areas holding. So pretty simple concept, one that we're going to use. Bear with me 2 seconds here. Just another look at, trigger line positioning on this next slide. Notice what happens. The large triggers roll above a Fibonacci support, and then we get this little false breakout to the downside, and the market instantly reverses back up to the upside. The only thing about this is the positioning, again, of our large triggers not coming along for the ride. And we saw this on crude oil today. Of course, it was at the top, not the bottom. But a little overrun of a key support or resistance area to instantly reverse it. The thing to really keep in mind is where are the large triggers relative to our support and resistance. Now, the large triggers can also be just like the small triggers. They can be a leading indicator. And, I know everybody says there's no leading indicators, and I say phooey on that because then we'd be out of business. We can recognize when a red Fibonacci resistance zone is going to break because our large triggers continue to trade through them even though price is trying to bounce off of them. The market respects the area and it bounces, but during this bounce we recognize that the large triggers are breaking through, so we know we're going to keep going in an upward direction. Does everybody see that, understand it? So Uh, Pretty easy. We'll go through questions in just a little bit. So what we do at NextGen, we teach 3 different types of trades. And I'm not going to go super in depth on the first 2 because the webinar is supposed to be about buying bottoms and selling tops, but I thought I'd at least give a little bit of an example. So a momentum trade is one of the easiest trades to recognize because we have sustained momentum in our MACDs, sustained wide, small triggers, and then we look for areas to buy or sell on a smaller time frame chart. And we use multiple time frame charts. We get a higher time frame perspective, and then we try to trade on the smaller time frame. We look for a tight stack of our trigger lines and our areas. Maybe it's large triggers and small triggers. Maybe it's small triggers and Fibonacci areas. Maybe it's small triggers in our Keltner channel in a Fibonacci area. So, but we're looking for a tight stack, and then we want confirmation from a higher time frame that our area is right and that our anticipated outcome for that area to hold is right. Remember, we've spent a lot of time talking about the anticipation of something holding or breaking. To be able to know in advance, this area should hold, and that's why we're buying here. This area should break, that's why we're not selling here, or whatever the case is. So let's take a look at a real chart. This is from what, April? So it's same thing. I've got thousands of examples, but it's the same thing that happens every single day. And I've got some of today's charts towards the end. But starting on the left side, this is the Russell. So those of you guys that don't trade futures, the Russell 2000 index futures. But what we look at is small triggers breaking below our large triggers, Fibonacci support breaking, and then we get a retracement. Now, once we get this retracement back up into this Fibonacci zone, we end up with a momentum short on the smaller chart to get us in. So momentum short, keep in mind the rules. MACDs have to be strong. Small triggers have to be strong. Let's take a look at it just a little bit closer. Notice we overran a Fibonacci resistance on the small chart. But look at what we have. We're breaking below our Fibonacci support. We have Fibonacci resistance, large triggers, our mid Keltner channel, and our small triggers all coming together. And does everybody see that momentum wide look on our small triggers right here? That's what we're looking for when we're going to take a momentum short trade. Now, I do have videos and really in-depth stuff on all these rules, but this is what the MACDs look like at the same time. I kind of blew this up a little bit, but do you see how the MACD dots are outside the lower Bollinger Band? So when we get that look coupled with the same look, small triggers breaking the large in an area, we end up with a momentum short. Now if we, just to kind of go back to the big picture here, so if we look at Fibonacci resistance on our large chart, now we can start looking ahead into the future and saying, where is this thing going to go down to? And this is another big benefit of what we do. Not only do we know how to really precisely get you into the market with the least amount of risk, we can also start to look ahead on our chart and say, wow, here's a target area, Fibonacci blue line on our small chart. It's the same Fibonacci support on our larger chart. So we have, this is $400 of room to the next Fibonacci area. So when we're going to take a trade, one of the other things we want to look at is, hey, how much are we risking, number one? And then number two, how much are we going to make if we get into this trade and it does what it's supposed to do? You can see, obviously, it broke through that one, which was clearly indicated by what the triggers were doing, and made it to the next Fibonacci area. So all in all, that move was about, what, $800 right there? So that's a real nice move, obviously. Not always going to get $800 moves in the market, but $150, $250, $300 moves. If you guys want to see more examples of this, you can go to our website. download the user guide. I've got about 100 different examples in there. The second type of trade that we're going to go through is trend trades. Trend trades are very simple. Strong move, weak retracement, areas for selling, same tight stack of the trigger lines, and we're going to end up with a trend trade. Now, when we look at a larger time frame chart, there are times when we have a high potential for trend trades to win. And if you notice where these circles are, that's when we have a momentum look on our large chart in the MACDs. What we talked about, that little stab back or that little pullback. You see these tails that are on the large chart? I put boxes on all of them. So we're getting pullbacks with the trigger lines going up on the large chart. Those pullback areas are the spot where you're to take a trend trade long, obviously, or if the market's going down, you're taking trend trade shorts on pullbacks. So we can really define very particular rules. So let's take a look at what it looks like on a smaller chart. This is what I call the perfect trend trade, if you will. If the higher time frame's with us, we're going to go on that assumption. And we've broken through Fibonacci support. We've pulled back to our large triggers, which are wide and down. Remember the first touch of the large triggers? Then we have small triggers touching large triggers. Remember, that's important. And then we also have price action, red Fibonacci resistance, large triggers, small triggers, and our mid-Keltner channel all coming together. And then, even more importantly, we can look out into the future and see where this thing's going. So this ends up being a really, really good trend trade that you guys can do. Still not what I wanted to teach you guys, but I wanted to show you, what we're doing. So just to kind of look at it real quick from a multiple time frame perspective. This is divergence on the larger chart. You can see the yellow line there. This is the first touch of small triggers rolled over on the large chart, which coincides with a breaking of support, pulling back to the resistance in a Fibonacci stacked area right here that allows us to take this trend trade with nothing in the way to Fibonacci areas. If you only did this trade for the rest of your life, you could make money most days. If that's all you ever did, is wait for this setup. So, I have traders that's all they trade, and they've done it for years, and that's what they do. Here's another example, just a long example, if you will. Notice we had divergence on the bottom here. The market broke through Fibonacci resistance. So where this box is what we're talking about right here. And notice that stab back into the support area and stab back into the large triggers. That sets us up stabbing back into a Fibonacci support in our mid-Keltner channel for a trend trade long. Notice the large triggers didn't come along for the ride. Remember that nuance that we talked about? So when you put together the large chart and the small chart and the anticipated outcome of the indicators, traders, when they put all this together, are trading 75 to 85% winners or better. The idea is to wait until you get all these conditions to come together so that way you have the highest advantage. All right, so now the big money maker. Selling the top or buying the bottom. Those other trades, momentum trades and trend trades, are great. And it's been our bread and butter for over 10 years now. Counter trend trades from Fibonacci support and resistances that you anticipate to hold will make you twice as much money, because you don't have to wait for that move and then a pullback and then take a trend trade. You're in from the top or you're in from the bottom. So what do we want? Again, the same thing, confirmation from a higher time frame chart with an area and an anticipated outcome that we know what's going to happen, or at least anticipate what should happen, I should say. Areas for buying or selling on the smaller time frame, and then we're going to talk about the correct bar structure for an entry. Now, what does that mean? Bar structure is the key for this type of trade setup. Now, when you look at these Renko Spectrum bars, and there's lots of different bars. We've got Pro Renko, Renko Spectrum, the Bloodhound guys, which I'm going to show you some Bloodhound stuff in a minute. I know Morgan had talked about Jeremy Tang. We use his software. We use it a lot, and I'm going to show you what it does here in a minute. But the bar structure that we're looking for specifically at Fibonacci areas is the tail to exceed the small triggers and the entire body of the bar. See the whole candle here? The whole body of the candle is beyond or above, in this case, the small trigger lines. And when we have this pattern, we typically will have a reversal. Now, here's one on the downside. You know what? Let me give you a closer look of the one on the downside here. Does everybody see this? How the tail exceeds both of the small triggers? And the entire body of the bar is below the small trigger lines. So this is the bar structure that we're going to be looking for. So when I say there's a bar structure there, that's what I'm talking about. So let's just take a look just at a bar, at a Fibonacci area, and what happens. Notice we have a blue Fibonacci support area here. And then notice the bar structure. The tail pokes below both triggers. The small triggers are not threatening breaking through that support area. Remember, we talked about that nuance. It's important. Okay? So we don't anticipate this Fibonacci support area to break. Then we end up with a bar structure, reversal bar to the upside. Now, remember the other nuance that we talked about, guys. How far away are we to our large trigger lines? Remember we talked about that snapback effect? The farther you are away from them, typically, the faster you're going to snap back to them. Now, when we add together all of these rules, we end up with a larger chart area and direction we anticipate to hold. Then we get a setup on a small chart at a Fibonacci area or maybe an outer band with a bar structure. We're able to buy this bar right here. Right as this bar starts to close, we're getting in. And we've got our risk 2 ticks below this bar. So this is almost the least amount of risk you can possibly get in with a confirmation of a trade setup. You know, typically on these types of trade setups, you're risking $100, $110 in crude oil per trade. So, you know, that's the bar, reversal bar is typically about $100. So if you look at this bar being $100, look at how much reward potential you had. So we're talking about risking $100 to make $200, $300, $400 on these types of trade setups. All right, so we talked about Bloodhound just to kind of give a little bit of a heads up. Sharkindicators.com is their website. We use their software. It does a lot of fantastic things. Just to kind of give you a little visual, this is what the Bloodhound looks like. It allows you to write all the different conditions for the things that you want, string them together, and then get a result. And that result's going to paint the background for you. So in this scenario, and I've put this template on our website so you guys can have it, create a big reversal bar. So that's really what we're doing, is we're creating that reversal bar using the Bloodhound software, and that's just how I got the background painted. So if you guys see these red and green stripes that are on here, so it's a really, really neat tool to be able to visually see some of the things that you're looking for with your trading. A word of caution, take a look at this chart, guys. You can't trade every reversal bar. You will lose your bacon. Okay? Notice what this market is. Number one, it's choppy, but you get reversal bars up and down all over the place. You know, it's just like trying to trade every moving average crossover or every stochastic overbought or oversold. You can't do it. It's only when you put together layer upon layer of Fibonacci outcomes, We've also done further work in the Bloodhound, just to kind of give you a little bit. We've automated, in an automated trading system, a lot of the Fibonacci rules and trades for you guys. So, there's two schools of thought and two types of people out there. There's discretionary traders and there's system traders. And really what we do is we teach discretionary trading, and we've done it for 13 years. And, we're venturing in, because of the power of the Bloodhound, into the fully automated range. So we actually have a system written that will generate buy and sell orders for you. So this is an example of one of the systems. And if you notice, Fibonacci resistance, reversal bars, system got short on a limit order pullback, and bar structure for an exit right here. So, the Bloodhound allows us to automate multiple time frame analysis. We've also automated things like our trend trades and our momentum trades as well in the system. So we've got, counter trend trades and trend trades all put together for you in an automated system. Now, let's take a look at some of these tops and bottom trades and bar structure trades and see what they look like when you put together the large chart and the small chart in concert with each other. So I'm going to start always on the left side of the chart, which is our larger time frame chart. And you'll notice we're breaking Fibonacci support. And you can see by the look of the small trigger lines that we anticipated that Fibonacci support to break. We weren't trying to go against that trend. But when it does break, notice where this circle is. We get that deep pullback against small triggers going down. Remember that rubber band effect we talked about, or that snapback effect? Having back into this area, now we go to our smaller time frame chart, and if you notice what happened, we get a bar structure short at a red Fibonacci resistance area on our smaller chart. Guess what, guys? That's everything that we need for a counter trend short trade from a Fibonacci area with a higher time frame anticipated to hold. So we get the anticipation first from the large chart, then we go to our small chart and say, give me an area and give me a bar structure and turn me loose. And you see what happens. This is crude oil at 93.95, almost instantly down, $400 or $500. I mean, that's a big move, guys. $400 or $500, even if you took $250 of that move, that's a great move. So let's take a closer look just at what the bar structure bar looked like on that trade. Can everybody see that? The wick went above both triggers. The body of the bar is below it. We're at a red Fibonacci. Off to the races. All right, here's another example. Notice on our left side chart, which is where we always start, remember we talked about that pullback to the small triggers when they roll over, that we're going to use that? Well, that's what it looks like on the large chart. Once we get that pullback, that's an area that we anticipate could go down. Now we go to our smaller chart and we take a look at it and we say, okay, give us our bar structure, and we're going to be going short right here. That's not at a Fibonacci area. That's okay. It's in an area. Doesn't always have to be Fibonacci area. It's nice when you get both. It doesn't have to be. Now, one more thing I'd like to point out. Look at what our, let me see if I have another slide that's a little bit closer here. Look at what, this is a close-up of our large chart right here for you. So you can see that pull back into the small triggers rolling. And then here is a blow up of the entry reversal bar to the downside. Notice the bar structure. And then also notice, look at what our large triggers were doing when price action was trying to go up. The large triggers were saying, no, 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 we're not going up. So you couple the anticipation from the larger chart with the bar structure on the smaller chart and the read of the large triggers, and you end up with short trades. All right, so let's do another one here. And you guys, these are all going to look very, very similar. Small triggers are breaking through, going very strong. We stab all the way back up to a Fibonacci area on our large chart at 93.34. Where's this market going to go to from 93.34? Well, look down here, 92.56. That's the target. You know, that's almost $750 target from Fibonacci area to Fibonacci area. But this is what the entry looks like at the time of what we're looking at. So if we look at the larger chart, just to kind of take a peek at it, you can see right here where the small triggers we're going through pulls back right to that Fibonacci resistance. Right at that exact spot, we're looking to go short, guys. That is what you call maximum reward, minimum risk. Does that make sense to everybody? Here's just one more example. Then I'll move on to, I got a couple charts from yesterday and today, and then so we had divergence on a higher time frame. Remember, we talked about divergence being an anticipated reversal. And then we run straight up into Fibonacci 1-to-1 and an outer band and put in a bar structure short. Give me one of those a day, I'm going to be a happy man. This is what you're going to see when you get the right counter trend trade. Using all this together, you're going to see the potential to make $200, $300, $400 on a trade setup. And those people who are waiting for trend didn't get them. They just fell. But if you were short from the top, you had just a little bit of risk and a whole bunch of reward potential. All right, I'll answer questions in just a little bit, guys. Okay, I'm getting closer to being done here. So let's take a look at yesterday's Russell chart. Larger chart on the left, smaller chart on the right. This is almost the whole day. 9 o'clock Central, large charts at Fibonacci going up, large charts pulling back to the large triggers going up, and we end up with a bar structure at the low, and trend trade to follow up to get the rest of the move up to what? Your target areas. If you were long from here, or even if you skipped that one and you were long from here, to be able to look out into the future and see that this is your target area, you're going to make a lot of money. Then you can see coming down from the top, small triggers below our Fibonacci, crossing down, price tries to go up, it can't do it. This is the exact spot, guys, right here, 1079. You're on your toes, you're waiting for the market to start going down, and you're going to take a trend trade short. You had bar structure at the top, you had trend trade to follow it up, and if you guys can't make money with these types of moves from these areas, then we're in the wrong business. That's about as easy as they get right there. Here was today's crude oil, just to give you a quick snapshot. Remember I told you it was range bound? Look at the bar structure from the Fibonacci at the bottom of the range. Look at the bar structure from the Fibonacci at the bottom of the range. Look at the bar structure from the Fibonacci at the top of the range. And then let me go a little further into the range from 9:45 to about 11 o'clock. And notice bar structure up from the Fibonacci, bar structure down, bar structure down. That's a lot of money to be made in a very tight range. It's only a 35 tick range right there. But really back and forth between it about 4 times or 5 times today before lunch, guys. You know, the question has been asked, is it working Forex? Yes. Here's today's Euro US dollar. See Fibonacci resistance? See the small triggers, and we're anticipating Fibonacci resistance to hold. Same thing, Fibonacci resistance, traded all the way down to Fibonacci support. So, you know, 35.12 all the way down to 34.79, not a real big range, obviously, after that big move the other day. But, you know, these are the spots. This is the larger chart. These are the spots that on the smaller chart, you're looking to get in and take your day trades. One more chart, and then I'll be done with charts, guys. Here's Apple from today. Any of you guys are stock traders? Same software, same settings, same everything. Obviously a little bit of a bigger bar because there's a little more range in Apple. But you can run this on small ranges and day trade to your heart's content. You can run it on larger charts. This works, guys, on just about everything in every market and every time frame. It's just a function of what you want it to do and how many trades you want to take. So, but just look, Fibonacci support. Look at what the large triggers were doing. You know, this same thing happens every single day, guys. It's really that simple. Look at Apple right there at 483.68. And then we trade all the way up to 487.43. That's what, $3.50? You know, I cringe at the idea of, you know, trading for $1 a point. But let's just say, hypothetically, you were an options trader and day trading stock options. Wouldn't this little blue circle right here be a great spot to put your option position on? And wouldn't that be a great place to get rid of that day trading option and liquidate it? So, you know, I'm not really an options trader, never traded options, but if I was an options trader, that's where I'd be getting in with my call, and that's where I'd be liquidating it. And if you guys want to, on our website, nextgent3.com, on the user guide, I put page 2 up here for you just so you can see it. We go through, these are all videos. We go through discretionary trading versus system trading. What are all the indicators? What's Bloodhound and how do we use it? We also have an educational chat room. And then I have really in-depth videos of all the rules and setups. I know I kind of skimmed over them. But you know, get into our user guide and go to page 2 and watch these first, at least these first 2 videos. They get very in depth into momentum and trend trading and counter trend trading rules using our software. We also spend a lot of time, you know, talking about management. On that page also we talk about when you're in a trend trade or a momentum or counter trend trade, where do you place your stop? You know, what's going to get you out of a trade? And in this little PDF that's on our user guide, there's all these little links or videos, and they explain each of the concepts. So if you're in a trend trade and get in one, where do you put your stop? What's going to say, get me the heck out right now? What's going to be the look of the indicators to keep you in? And then how are you going to manage that position down, you know, trailing stops and trading it down to a target? So, you know, I really want to talk about what we talked about in the beginning, successful trading. You have to know where to get in with the least amount of risk, and you have to know where to get out with the maximum profit or the minimum loss. And if you learn our software and you apply our software correctly, you're going to be in at the very best spots, and you're going to be in at the edges, and you're going to be able to, you know, really to think about the key benefits. You're going to have exact entries and exits. You know, it's not, maybe this is an area, maybe it's not an area. This is exact science, guys. This is your area. This is why you're doing it. These are your rules. Go. You're going to have the ability, more importantly, to predict in advance where these trades are going to happen. There's no trade that just sneaks up on you. Oh my goodness, I didn't see that we had Fibonacci resistance and all my trigger lines are going down there. I should be going short. You can see this stuff coming minutes, hours, days in advance, depending on what size chart you're using. We're also going to be able to have very low risk, because if you get in at such a tightly defined area, if that area breaks, get out. You lose just a little bit, part of doing business. But if it holds like it's supposed to, you're going to be able to achieve the highest reward for risking your money on the market. And then you're also going to get the benefit of us writing our logic into the Bloodhound and into our software and into a trading strategy, and you're going to get system automation along with what we do. So, you know, not only are you going to learn it and know it, but we're going to be automating it. We've automated it, but obviously automation gets better and better as time goes on. So think about what $250 a day means, you know, and I like to do this just to kind of bring it back. You know, if you can make $250 a day on one contract, and you can be consistent with it. And the important part of this is consistency. You know, our methodology has been out there for 13 years, and it's been consistent for 13 years, and it works absolutely 100%. I can guarantee that our methodology, when you apply it correctly, works. I can't guarantee that you're going to do it properly. That's the only part of the guarantee that kind of falls apart and why nobody gives a guarantee. Bruce, no, there will be no trade station. The fibs run on TradeStation, but all this other good stuff, TradeStation's getting left in the dust. So no is the answer. But think about it. You trade one contract, you make 250 a day. Most of those trade setups I showed you guys are way more than $250. You know, just to go look at just one system trade, you know, at the 78 range, 78 to 98. This is, you know, $200 just on one system trade right here. You know, these reversal bars and these bar structures are great for managing your trades also. But to make this $250 a day, you know, everybody can do a spreadsheet, but I can absolutely tell you that we can teach you how to make 250 a day and do it consistently. If you do that, you ramp up over the course of time to 10 contracts, which is not a lot. It's a lot for a lot of people, but it's not a lot. You're going to make $500,000 a year, guys. So when you think about it from a business perspective, and that's what trading is a business. It's not a hobby. It's not for fun. It's a business. You have to make money at it, or else it's a very expensive hobby anyway, I guess I should say. But to really be able to trade 10 contracts with a $50,000 to $100,000 account, and to have a $500,000 a year annual earnings, even if you just stop at 10 contracts, that's huge. Most people don't make $500,000 a year in their professional careers. So, you know, that's really, I like to kind of bring everybody back to the money, because that's really what trading is about. We also run a classroom, you know, for 3 hours in the morning in HotCom. So, you know, not only the user guide, but the classroom will allow you to post charts, ask questions. Our educator walks through live charts during the day, discusses setups and what's working and what's not working. So we have that available to you as well. And then we're going to make a special offer for you guys that are here. I always get asked the price, so I'm just going to tell you what it is. The Pro Trader costs $7,500. The Revolution, which is the automated system behind the Pro Trader, costs $5,000. So, you know, we do a package deal for both of them for $9,500. If you guys, and you're going to have to be quick, and you're going to have to make a decision quick, but I'm going to make it worth your while. If you purchase the Pro Trader by the close of business on the end of the month, which is Monday, so you got to get a demo loaded and work your butt over the weekend if you really want to test it out, I'm going to give it to you for $5,000. So I'm going to save you $2,500 off of the cost of the Pro Trader itself, and I'm going to throw in the automated trading system for free. So, you know, the package deal we sell for $9,500. So essentially, I'm giving you $4,500 off the cost. And I've never really discounted it that much, but I'm going to do it one time. And on October 1st, don't ask me for it, please. So anyway, if you take that $5,000 deal, doesn't include Bloodhound. Bloodhound's $495. Even if you don't buy mine, you need to buy a Bloodhound and learn how to use the thing, because it's a very, very powerful software. So what do we give you in the demo? Just to kind of give you, we give you full working copies of all of our software, the Pro Trader, the system. We're going to get you a demo of the Bloodhound software. We're going to get you a demo of the templates that we run in the Bloodhound. We're going to get you NinjaTrader if you don't have it, and live futures data. For those of you guys that want to do stocks or Forex, you can pay $70 to Kinetic and test it out on those markets if you want to. You're going to get participation in our live chat room. Obviously, you're going to get fantastic support from us. And we're going to give you everything really that you need to build a trading business if you don't have anything or any clue yet on what you're going to do or how you're going to do it. Then we do offer financing on our products. So, we have guaranteed financing for everybody, regardless of your credit situation. I know some people have been roughed up during the recession. So, but that's for U.S. clients only. We're not traveling overseas to come visit you. So, we will definitely uh, finance you if you need financing. Um, Take the time, guys. Get to our website. If you're not already in our system, if you're in our system, just call us. Go to our contact page, call us, tell us you want to get started. We'll get you loaded. If not, go into the demo page, sign up for a demo, and I really appreciate everybody's time and attention in today, and I appreciate everybody at the Trading Pub and allowing me to come in and make my presentation. We go a lot more in depth into all these concepts on our website and videos, which I can't do in an hour and 15 minutes. Sorry, I kind of ran over. So again, I appreciate it. I'll be happy to answer any questions as long as you guys want to stick around and ask them. If you've asked them way back in the past, I'm not scrolling up. Please ask them again. The finance terms are minimum $1,000 down, and if you pay inside of 6 months, it's interest free. Beyond that, it runs about 18%. So you can put 1,000 down and pay, $200 or $300 a month. If you don't see the ability to make $200 or $300 a day, guys, don't buy it. I mean, you should be able to pay that monthly note, with every day's worth of trading profits. The deal's $5,000, Matthew. 5,000. You're going to get the Pro Trader and the Revolution automated system. I didn't get in depth into it. You can go on the website and look at it a little bit more. But you're going to get everything, the whole shooting match. Pro Trader, educational room for a year, and the automated trading system for $5,000. You just have to be quick about your decision before the end of the month. Instead of $9,500, Matthew, that is correct. So that's a $4,500 savings over what we charge for that package, and that's purchased. You don't have to be a day trader to take advantage, Nanik. You can run our software on longer term charts as well. We cater to the day traders because there's a lot more teaching opportunities during the day, but the same rules and same methods and everything applies. It's just a bigger chart. Nanik, no. The only thing that we do charge is a $4.99 every 6-month fee for upgrades and modifications to the automated trading strategy. But as far as the Pro Trader and all the Revolution indicators, you own those. The only maintenance fee is on the system once every 6 months, but you're not obligated to pay that if you're not using the system. HH, the average, it's a linear regression, 20 period, 80 period. Short version. Matt, the majority of our clients are running through AMP Global Clearing. And, we've worked with them for a long time, and they do a really, really fantastic job. They match anybody's commission rates out there, and they're really, really growing and very stable. Everybody who is there, highly recommends them. Where you trade, again, is your business. My job and my goal is to make sure that you understand where to get in and where to get out, and you understand how to read the market efficiently. Where you put your money is really up to you. It's personal business. You can finance the 5K deal, George. Doesn't have to be paid in full. Yogesh, we don't have a stock scanner. So there's not really, in the next version of NinjaTrader, they say they're going to have a better scanner, so we'll see. But as it stands right now, we don't have a stock market scanner for swing trades. Hopefully in the next version of NinjaTrader, they'll do that. Bruce, we'll work on something for you on that. Okay. Yep. Go to our contact page, fill out a demo, and we'll call you. I promise. For the counter trend trade, what time frame is used in our system? Right now, I've set it up for crude oil and like Russell day trading, but I use a 12.3 and a 4.1. But you can change those times depending on what you want to do. There's nothing that we do, guys, is hard coded, set in stone where you can't mess with it. You can change time frames, you can change markets. It's more of a gray box than a black box. William K., if you already bought the system, congratulations to you. Nanic Thinkorswim platform, okay. Well, you can't, our software, you need to run a NinjaTrader. You can trade on your Thinkorswim platform if you really want to, but our software, you need to run a NinjaTrader so you can do the analysis. You can test the system for free, sure. Absolutely. Just fill out the demo form and we'll get you set up. Bruce, I answered that question already. We'll discuss that with your salesperson. We'll work out something for you. Okay, Bruce? What is the short time frame and the longer time frame you compare? It's really range type charts, Lori. In my user guide, in the first section, there's a video on what these bars are and how we actually use them. Let me see. Bear with me a second. I'm going to give you a link. There's a link to a video on the bars themselves, because I know the bars are kind of confusing. A little YouTube video. HH, I have answered that twice. Are you ready this time? It's a linear regression, 20 period moving average. 20 period average. And it's an 80 period average for the big one. And Lori, sorry, that maybe not answer your question, but it's a range bar chart, so it's not a time frame, I guess is the best way to put it. All those bars are based on range. And when you guys come in our live educational room, when we get you on demo, you'll see it, and you'll be able to, there's people in there who've had software up to 10 years. So, there's people in there who are brand new, and there's people who have had software several years and 6 or 7 years, and then some have had software in there 10 years. There's a lot of people in there. And like everything else, guys, it's a tool. You need to use the tool properly. So that's really what our job is, not just to create the proper tool, but to be able to teach you how to use it properly. And that's the most important part. All right, guys. John T's had software for 10 years. Yep. That's a long time. We give you HotCom for a year with the purchase of the software, but the HotCom fee is, for the light version, I think it's $59 every 3 months. Don't quote me on that. I'm pretty sure that's right. All right, guys. Anybody else have any questions? Of course, we do this live all day, every day, guys, in our educational room for people who are loaded up on demo. So, there's a lot of video content to go through, and, I kind of skim the surface of all this to get it done. Not very quickly either, but that's about as quickly as I could skim the surface. Well, the website will tell you what you need to know if you go through the user guide, but I know they're going to send out a link to everybody who signed up so you can watch a video replay of this as soon as they get it done and load it to a website. Yes, Angelo is the answer to your question. It does generate buy and sell signals for you. However, there's right now you can't have an automated trading system that is going to be as good as a great discretionary trader, but we'll definitely get you started with automated buy and sell signals, teach you how to manage them. And that's sharkindicators.com. You can go read up on the Bloodhound. Dylan, you asked that question. All right, guys. I appreciate the time. Morgan, I appreciate everybody there. And you guys have a fantastic evening. Looking forward to talking to a bunch of you guys tomorrow in our educational room.
All right, good deal. Thanks again, John. We appreciate you being here, spending this time educating our traders. Also, Jeremy, appreciate you and Shark Indicators' support of the Trading Pub. I hope that you guys will definitely check them out. Try to learn more from both John and Jeremy. And again, like I said, you've got great comments here in the chat area. I'll try to get the recording posted hopefully by tomorrow. So we'll get that posted and emailed over to you. But I hope you guys have a wonderful evening. Thanks again for being with us.